Okay, so picture this. You're looking at your brokerage app, right? You see a stock you want, price is flashing, say $50. You hit buy. You think, okay, $50 a share, got it.
Yeah, it seems straightforward.
But then you check the confirmation, and it's not $50. It's like $50.05.
Or the flip side, you sell expecting 50.
Exactly. Expecting 50, but you only get, I don't know, $49.95. What just happened there? That little difference?
Sure.
It seems tiny, right? Pennies.
Seems like nothing almost.
But it's actually this fundamental cost, this ever-present thing in trading that honestly a lot of people just overlook.
And you're absolutely right. Those pennies, they aren't just noise. I mean, think about the sheer scale.
Yeah.
Millions, billions of shares traded every day.
Wow. Yeah.
Those tiny spreads, they add up. They're actually a huge, crucial part of how the whole financial system works. It's not a mistake.
It's the system itself.
It's the system. It's the bid-ask spread. It's like the oil in the machine of stock trading.
Exactly. It's the cost of entry, almost, the cost of playing the game, whether you notice it or not.
Right.
So let's really, pull back the curtain on this. Because at its heart, the stock market is just this giant, nonstop auction.
A constant negotiation, yeah.
A negotiation between buyers and sellers. And on one side, you've got the highest price any buyer out there is willing to pay, like right now. That's the bid.
Okay, the buyer's top price.
Then on the other side, you have the lowest price any seller is willing to accept for their shares. That's the ask. Or sometimes people call it the offer.
Okay, bid and ask. Highest buy price, lowest sell price.
Got it. Think of it like maybe an antique auction, but instead of one vase, it's shares of stock.
And thousands of people potentially bidding and offering at the same time.
Exactly. People yelling out their highest price, that's the bid pile. And others maybe whispering the lowest they'll take, that's the ask pile. The market's job is constantly trying to match them up.
Matching the top bid with the bottom ask whenever possible.
And the gap, the difference between that highest bid price and that lowest ask price, that's it. That's the bid-ask spread.
Okay.
So if the highest bid is, say, $10,
Yep.
and the lowest ask is $10.05.
Right.
The bid is $10, the ask is $10.05. The spread, 5 cents.
5 cents. It's that little gap between what the keenest buyer is putting up and what the most eager seller is demanding right at that instant.
Crucial, but often kind of invisible, right?
Totally.
So our mission today for this deep dive is to take all this source material we've gathered, articles from finance sites, explainers, even this really interesting Reddit thread we found where traders were hashing this out.
A mix of expert views and real-world questions, yeah.
Exactly. And we want to use all that to explore the spread thing from, every angle. What is it really? Why does it even exist? How does it hit your bottom line when you trade?
And what makes it change?
Yeah.
Sometimes it's tiny, sometimes it's huge. Why?
Right. What makes it widen or tighten up? And ultimately, how can knowing all this stuff help you, the listener, make, smarter decisions in the market, more informed choices?
Yeah, we want to pull together these different viewpoints to give you the whole picture.
Because just seeing that one price flash on the screen, that's only half the story.
Or less than half, sometimes. Understanding the spread means understanding the forces underneath, the actual costs involved, and how trades really, really happen.
Okay, let's do it. Let's start with the core mechanism. The bid, the ask, the spread, how they relate.
Absolutely. So like you said, the bid, that's the absolute top dollar a buyer is ready to pay right this second for a share.
Max price from a buyer.
And the ask. The absolute rock bottom price a seller will take, again, right now, for that exact same share.
Minimum price from a seller.
And the sources gave that simple example. Bid $10, ask $10 or 5. That 5 cents, that's the spread. It's just the numerical gap.
And it's not just some random number pulled out of thin air, right? It's live. It reflects those basic economic forces everyone learns about.
Supply and demand.
Exactly. Supply and demand. The stock market is basically this ongoing auction, right?
Continuously happening.
So if there are more people wanting to buy than sell at a certain price, demand is higher.
Price goes up. Buyers compete.
And if more people want to sell than buy, supply is higher.
Price goes down. Sellers compete.
And the bid and the ask prices, they're like the absolute front lines of that negotiation, the very edge. The points where a buyer and seller could potentially meet if someone decides to cross that gap.
Yeah, the highest bid and the lowest ask are basically the potential transaction points right now.
Which brings us right to that crucial idea. The spread as a transaction cost. This is where that hidden cost we talked about at the start really comes in.
Right, because when you as an investor put in a standard order to buy some shares,
A market order, usually.
yeah, typically a market order, you're essentially agreeing to pay whatever the lowest ask price is at that moment. Your order goes and finds the cheapest sell orders waiting out there.
So in our example, if the ask is $10 or 5 cents, that's likely what you pay per share.
That's the price you hit. And the opposite is true when you sell. If you put in a standard sell order,
Okay.
you're generally agreeing to take whatever the highest bid price is at that moment. Your order finds the highest buy orders waiting.
So if the bid's $10, that's what you'll likely get per share when you sell.
Precisely. And here's the kicker, the implication. If you buy a share at the ask, $10 or 5 cents, and then immediately turn around and sell it at the bid, $10.
You instantly lose 5 cents.
Instantly. That difference, the spread itself, is the immediate cost for doing that round trip, buying, then selling.
Wow. It's like a tiny toll you pay just for getting in and out of the stock, separate from any commission your broker charges.
It's a friction cost. It's built into the market structure.
And, okay, 5 cents on a $10 stock? Maybe it doesn't sound like a disaster if you buy, like, 10 shares.
Right. For a small trade, maybe not.
But what about bigger trades? Or people who trade really often, day traders, for instance?
That's where it bites. The sources had this other example, a much more dramatic one. Imagine a stock, maybe less common, with a $7 bid.
Okay, $7 bid.
And a $9 ask.
Whoa! That's a $2 spread.
It is a big one. Now think about buying that stock with a standard market order.
Okay, I hit buy. I pay $9, right? The ask.
You pay $9. Now imagine you immediately need to sell it for some reason. You hit sell.
I only get $7 back, the bid.
You get $7. You are instantly down $2 per share purely because of the spread.
Just from the transaction itself.
That's a massive percentage loss on a $9 purchase. What is that? Over 22%. Gone. Instantly, just to get in and out.
Wow. Okay, that really drives it home. A $2 loss just to break even. That's a huge hurdle before you even think about profit.
It really highlights why this matters. For someone trading thousands of shares, even that 5-cent spread adds up to serious money. Hundreds, thousands of dollars.
And for frequent traders, it's death by 1,000 cuts, right? Nibbling away at returns constantly.
It is. It's basically the market charging you for the convenience, for the immediacy of being able to trade whenever you want.
Okay, so bid and ask reflects supply and demand. The spread is the gap, the cost. You cross it when you trade using market orders. So who's on the other side? Who's actually setting these bid and ask prices all the time?
Yeah. Who facilitates this?
This is where we need to talk about market makers.
Absolutely essential players.
Yeah.
Market makers. You could call them the grease in the wheels, maybe? Though, their role can be complex, sometimes a bit misunderstood.
What's their main job?
Their primary function, their reason for being, is to provide liquidity.
Liquidity. We keep using that word. Define it again in this context.
Liquidity here means how easily you can buy or sell something like a stock without your own order causing a big price change.
Okay. Ease of trading without moving the price too much.
Exactly. And market makers provide this by always quoting both a bid price and an ask price for the stocks they cover. They stand there, electronically speaking, ready to buy from anyone wanting to sell at their bid, and ready to sell to anyone wanting to buy at their ask.
So they're always willing to take the other side of the trade.
Pretty much. To do this, they have to hold an inventory of the stock. They're basically creating this continuous two-sided market. So you don't have to wait around hoping another random investor wants to do the exact opposite trade at the exact same moment you do.
They bridge that gap. They make the trade happen faster.
They facilitate it.
Okay, so they're providing this vital service, making trading smoother, and they're taking on risk, right? Holding inventory that could go down in value.
Definitely risk involved.
So how do they get paid for this? What's in it for them?
Their compensation, their main profit engine, comes directly from that bid-ask spread we've been talking about.
Okay.
Their whole business model is basically try to buy shares from sellers at the lower bid price they're quoting,
Right.
and then sell those shares, maybe from their inventory, maybe finding another buyer quickly at the higher ask price they're quoting.
So they capture the difference.
That difference, that spread, even if it's just pennies per share, is their potential gross profit on that cycle of buying and selling. Going back to the $10 bid, $10.05 ask example, they're trying to buy shares from people hitting the $10 bid and sell shares to people hitting the $10.05 ask. If they manage that cycle, they potentially pocket that 5 cents per share.
Okay, this addresses some of that confusion we saw in that online discussion thread. People were asking things like, how can they make money if the spread is so tiny?
Right, or It feels like magic money.
Yeah. Or why isn't the spread just zero if it's all electronic now?
All really good questions, and they get to the heart of it. First, why isn't the spread zero?
Yeah.
Because, like we said, the market maker is providing a service liquidity and taking on risk. The spread is their payment for that.
No payment, no service.
Pretty much. If the spread was zero, there'd be no financial incentive for them to stand there making the market liquid. Zero spread means a trade just happened, buyer and seller met exactly. It's not the state of waiting orders where there is a gap.
Okay. And how do they actually pocket that spread? Especially since when I buy, I just pay the ask price. It doesn't feel like I'm paying the market maker directly.
Right. Their profit isn't necessarily tied to your one trade in isolation. It's about the big picture, the aggregation of thousands, millions of trades over time.
Okay, volume is key.
Volume is absolutely key. Think of it this way. They're constantly posting their bid and ask. People who need to sell right now hit their bid. People who need to buy right now hit their ask.
Okay.
The market maker is buying shares at the bid from one group of people and selling shares at the ask to a different group of people simultaneously, continuously.
Ah, I see.
Their goal isn't to make money on every single share instantly bought and sold back.
Yeah.
It's about managing their inventory flow. They execute enough buys near the bid and enough sells near the ask over the course of the day, maybe milliseconds.
Right.
So that their average buy price is slightly lower than their average sell price across all that activity. That's where the profit comes from.
Okay, that clicks. It's not about one perfect round trip for them. It's about playing the averages across huge volumes, constantly trying to capture that spread difference overall.
Exactly. They aim to buy slightly more than half the time from sellers hitting the bid and sell slightly more than half the time to buyers hitting the ask. It's a high-volume statistical game.
Yeah.
Requires very sophisticated systems.
And risk management.
And major risk management, yeah.
The sources also mentioned a bit about history, like the difference between the old NYSE specialists and NASDAQ market makers. Seems technology changed a lot.
Oh, massively. Historically, yeah, the NYSE had one specialist firm per stock responsible for maintaining an orderly market. NASDAQ had multiple competing market makers.
Different models.
Different models. Today, it's also electronic with automated trading systems, high-frequency trading firms acting as liquidity providers.
Right.
The lines are blurrier, but the core function. Someone still needs to quote both sides of the market.
The need for bids and asks persists.
Absolutely. And it's interesting, the sources pointed out that spreads actually got much tighter in the U.S. after 2001.
Why then?
That's when they switched from quoting prices in fractions like eighths or sixteenths of a dollar.
Oh yeah, I remember that, like 50 and 18th.
Exactly.
Oh.
They switched to decimals, quoting in pennies. Decimalization.
Huh.
That instantly allowed for smaller price increments, more competition between market makers quoting prices just a penny apart, and naturally squeezed the spreads down.
Fascinating. More precision led to tighter spreads.
Okay, so the spread is the market maker's potential profit, our cost for liquidity, and it changes. That leads perfectly to the next big question. What makes it change? Why is the spread sometimes super narrow and sometimes really wide?
Yeah, what drives the width? This gets into the real market dynamics, and the sources were unanimous on the biggest factor: liquidity.
There's that word again. Let's nail the definition in terms of spread width. Okay, liquidity, for spread purposes, is all about how easy it is to buy or sell a stock without your order massively moving the price. It's about how many buyers and sellers are actively participating, how often it trades, the volume.
Okay, the level of activity.
Right. And the relationship to this spread is simple and inverse.
Inverse.
High liquidity equals a narrower spread. Low liquidity, what people call thinly traded stocks, equals a wider spread.
Got it. High activity, tight spread. Low activity, wide spread. Why does liquidity have such a strong effect?
Well, think about a really liquid stock. Tons of buyers, tons of sellers, all placing orders very close to the current price.
Okay.
For a market maker, that means if they buy shares at the bid, they're pretty confident they can offload them quickly at the ask because there's always someone else coming in. The risk of holding inventory is low.
They can flip it fast.
Right. Plus, high liquidity attracts more market makers wanting a piece of the action. That competition forces them to quote tighter spreads to win the business, sometimes just a penny wide.
Like those big tech stocks, Apple, Microsoft, their spreads are almost always just a cent or two.
Exactly. Millions of shares changing hands constantly. That volume, that participation creates the tight spread.
So what about the opposite, the low liquidity stocks?
Yeah, maybe a small company, maybe something that only trades, say, 5,000 shares a day. Far fewer buyers and sellers around.
Right.
So if a market maker buys shares at the bid in that stock, they might be stuck holding them for a while before a buyer shows up willing to pay the ask.
More risk for them.
More risk, definitely. The price could drop while they're holding it. So to compensate for that higher risk and the difficulty of moving the inventory, they quote a wider spread. They need that bigger potential profit margin to make it worth their while.
So check the volume, check the spread. They go hand in hand. What else affects the spread width?
Volatility is a big one.
Market swings.
Yeah. When a stock's price is jumping around like crazy, maybe there's big news, an earnings report, some economic shock, that increases uncertainty for everyone, especially market makers. The value of the shares they're holding could change dramatically very quickly.
So they protect themselves.
Exactly. They widen the spread. They need a bigger buffer between their buy and sell prices to cushion against those sudden moves. High volatility almost always means wider spreads, even for stocks that are normally liquid.
Okay, liquidity and volatility. What else?
Well, trading volume itself, which is obviously tied to liquidity, but worth calling out. Higher volume generally means tighter spreads. Lower volume, wider spreads. Simple correlation there.
Makes sense. Does the type of asset or the stock price play a role?
It can, yeah. Different markets have different norms. Like major currency pairs in Forex often have incredibly tight spreads because the volume is astronomical.
Right.
Whereas something like a rare corporate bond might have a huge spread. Within stocks, the price can matter. Very low price stocks, penny stocks especially.
Uh-oh, penny stocks.
Yeah, they often trade in lower dollar volumes, have fewer institutions involved, fewer market makers sometimes. So they tend to be less liquid, can have really wide spreads, percentage-wise.
Like a 5-cent spread on a 50-cent stock is huge, right? 10%.
Exactly. Whereas 5 cents on a $100 stock is almost nothing. It's critical to look at the spread relative to the price for those low-priced ones.
Definitely seen that. Okay, what else?
Time of day. Spreads aren't static throughout the trading session.
Oh, interesting.
They're usually tightest right around the market open in New York, like the first hour, and maybe again near the close.
Yeah.
That's when volume is typically highest.
Peak activity times.
Right. They can widen out during the middle of the day, that lunchtime lull. And they're definitely wider in pre-market or after-hours trading when there's much less liquidity.
Good tip for timing trades, potentially.
Yeah.
You also mentioned transaction size earlier. Does a really big order affect the spread I actually get?
It can, absolutely.
What?
Especially if the stock isn't super liquid. The price you see quoted, the best bid and ask, that's the NBVO, National Best Bid and Offer.
Okay. That price is usually good for a standard amount, typically 100 shares, a round lot.
Right.
If you come in with an order for, say, 10,000 shares, you might exhaust all the shares available at that very best price.
You eat through that level.
Exactly. Your order might then have to start filling at the next best price level, which is slightly worse, and then the next, and so on. So your average price for the whole 10,000 shares ends up being worse than the initial best price you saw. You effectively crossed a wider spread for your large size.
Slippage, basically.
This is a good way to think about it.
Okay, this leads to something else the sources mentioned. Market depth. How does that fit in?
Market depth is super important for understanding liquidity beyond just that top-level spread. The spread tells you the gap between the single best bid and single best ask.
Right, the $10 and $10 and the 5?
Market depth shows you the volume of buy orders waiting at prices below that $10 bid and the volume of sell orders waiting at prices above that $10 and 5 ask.
Ah, like a stack of orders on each side. Precisely. A stock might have a tiny 1-cent spread, $10 by $10 1 cent. Looks liquid, right?
Yeah.
But if the market depth shows there are only 100 shares offered at $10 and 1 cent, and maybe only 200 shares bid at $10, well, a 500-share market order is going to blow right through those levels and get filled at worth prices.
So the depth is shallow.
Shallowest depth. Conversely, a stock might have a slightly wider spread, say $10 by $10 and 3 cents. But if the depth shows thousands of shares bid at $10 and thousands offered at $10 and 3 cents, and good volume at $9.99, $7 and the 4, $10 and 5,
much thicker order book.
much deeper. That stock can absorb larger orders without the price moving as much. So true liquidity is really a combination of a narrow spread and significant market depth.
Got it. Spread width plus volume behind it. Okay, so liquidity, volatility, volume, price, time of day, depth. Lots of factors. Now, we've talked about bids, asks, spreads, market makers. How do we, as regular traders or investors, actually see this stuff, see the depth you're talking about?
That's where the order book comes into play. Think of the order book as your direct window into the live supply and demand for a stock on an exchange.
What does it actually look like? What does it show me?
It's basically a list updated in real time of all the currently open, waiting buy orders, the bids and all the open, waiting sell orders, the asks for that stock.
Okay.
And crucially, it organizes them by price level. It shows you how many shares are waiting to be bought or sold at each specific price point.
So it's way more than just the single best bid and ask number.
Oh yeah, much more. It shows you the best bid and ask right at the top. That's called the top of the book.
Right.
But then it shows you the layers below the best bid where other buyers have placed their orders, and the layers above the best ask where other sellers have placed theirs. And it shows the quantity of shares at each of those price levels.
That's the market depth visualized.
Exactly. You can literally see the stack of buy orders and the stack of sell orders. And that visible gap between the highest price on the buy bid side and the lowest price on the sell ask side, that is the bid-ask spread. You can see it.
Okay, seeing the order book makes it real. And this is where the type of order we place really matters, right? You mentioned limit orders versus market orders earlier.
Critical difference here. Absolutely critical for how you interact with that spread in that order book. The order book is mainly built out of limit orders.
Okay, define a limit order again.
A limit order is your instruction to your broker to buy or sell a stock only at a specific price or better.
Price control.
Total price control. If you want to buy stock XYZ, but only if you can get it for $10 or less, you place a buy limit order at $10.
Okay.
That order then goes and sits in the order book on the bid side at the $10 level. It's visible to others. It waits there patiently until the market price comes down to $10 or lower, and then it might get filled.
So it adds to the bid side liquidity.
Exactly. Same for selling. A sell limit order at $10.05 sits on the ask side of the book at $10.05, waiting for a buyer willing to pay that much or more. Limit orders build the book. They create the visible bids and asks.
Okay, limit orders, add liquidity, wait patiently. What about a market order then? How is that different?
A market order is completely different in its intention. It's your instruction to buy or sell immediately, right now, at whatever the best available price is currently sitting in the order book.
No waiting, just execute.
Execute now.
Yeah.
So when you place a market buy order, it doesn't go sit in the book. It immediately looks at the ask side of the book, finds the lowest price sell order waiting there, and takes it. Bang.
It hits the ask.
It hits the ask.
Yeah.
If your order is bigger than the number of shares offered at that lowest ask price, it takes all of those and then instantly moves up to the next lowest ask price and takes those shares and so on until your whole order is filled.
Wow, so it just eats its way up the ask side if needed.
It consumes liquidity. A market sell order does the opposite. It immediately hits the bid side, taking the highest priced buy orders available until it's filled.
Okay, so let's summarize that. Limit orders provide liquidity, sit in the book, give you price control, but no guarantee of execution.
Right.
Market orders take liquidity, execute immediately, guarantee execution if possible, but you sacrifice price control and pay the spread.
Perfectly put. Market orders cross the spread by definition. Limit orders try to get filled at a specific price, which might even be inside the current spread if you're lucky or patient.
And that market depth you see in the order book, sometimes called DOM, depth of market, that helps you judge the risk of a market order.
Exactly. If you see deep stacks of shares on the bid and ask sides close to the best price, it means a reasonably sized market order probably won't push the price too far beyond that best bid ask. There's a cushion.
But if the depth is thin, just a few shares at each level,
Then even a small market order could cause significant slippage, moving the price several cents or more before it gets fully filled. Huge risk there.
okay. Are there other tools people use alongside the order book to get a sense of things?
Yeah, definitely. Experienced traders pay a lot of attention to time and sales data. It's often called the tape.
Time and sales. What's that show?
So the order book shows you the potential trades, all the waiting limit orders. Time and sales shows you the trades that have actually happened.
Ah, completed transactions.
Exactly. It lists in real time every single trade that executes. The price it happened at, the number of shares traded, volume, and the exact time.
But how does that help, seeing past trades?
By watching the tape alongside the order book, you can see which side is being more aggressive. Are trades happening more often at the ask price? That suggests buyers are eagerly taking offers, buying pressure. Are trades hitting the bid price more often? Sellers are aggressively hitting bids, selling pressure.
I see. It confirms the action.
It confirms the action. You see orders disappear from the book, and then you see the corresponding print on the tape. It helps you gauge the immediate momentum and confirm if the price movements you see in the bid-ask are being driven by actual transactions. It's like seeing the battle after seeing the troop formations on the map.
Wow, okay. So combining the spread width, the order book depth, and the time and sales flow. That gives you a really granular, real-time view of the market's pulse.
It's incredibly powerful for short-term traders. Absolutely. It helps identify sentiment, potential support resistance areas based on where large orders are sitting, maybe even spot weird activity like huge orders suddenly appearing or vanishing, and it helps refine timing.
This isn't just abstract theory then. This has real practical uses for traders. So let's pivot to that. How can someone listening right now actually use this understanding? What are the concrete strategies?
Okay, strategy number one, the absolute baseline, comes straight from the sources. Use the spread itself as information before you even think about trading.
Just look at it first.
Look at it. Before you hit buy or sell, glance at the current bid-ask spread for that stock. It's your instant liquidity check.
What does it tell you again?
Narrow spread, maybe 1 to 5 cents on a reasonably priced stock. Suggests good liquidity. Probably easy to get in and out without moving the price much.
Okay.
Widespread many cents, maybe even dollars on low-priced or exotic stuff. That's a big warning sign. Low liquidity. Entering and exiting will cost you more and might be harder.
So don't just fixate on that last traded price. Check the spread first. It tells you the immediate cost and ease of trading right now.
Essential first step.
Yeah.
Second strategy. Think about strategic timing.
Like trading at certain times of day.
Yeah. We mentioned spreads are often tighter during peak hours, market open, market close. If you're trading something that's not super liquid, maybe waiting for those higher volume periods could get you a slightly better price, a narrower spread.
Worth considering if your trade isn't urgent.
Exactly. And then the strategy that was emphasized again and again in the sources, especially if you're dealing with wider spreads or volatile markets.
Let me guess. Limit orders.
Use limit orders. We talk about how they work, building the book. But for you, the trader, the key benefit is price control.
Right.
If the stock is $10 bid, $10.05 asks. Instead of a market order guaranteeing you pay $10.05, or maybe worse if the volume isn't there, you could place a buy limit order at, say, $10.01, or $10.00,
Yeah.
or even $9.09 if you're patient.
What happens then?
Well, you might not get filled instantly. Your order sits there waiting for the ask price to come down to meet your limit or for a seller to hit your bid.
No guarantee of a fill.
No guarantee. But if it gets filled, you bought shares cheaper than the current ask.
Yeah.
You potentially bought inside the spread. You significantly cut your transaction costs compared to blindly hitting the ask with a market order.
Let's revisit that crazy $7 bid, $9 ask example. Market order buy costs $9.
Right.
What if I put in a limit order to buy at, say, $7.50?
You wait. Maybe the ask never comes down that far. Your order doesn't fill.
Yeah.
That's the risk. But maybe sellers get a bit more desperate. The ask drops, and your $7.50 limit order gets hit. Boom. You just bought the stock for $7.50 instead of $9.
You saved $1.50 per share just by using a limit order. That's enormous on a $9 stock.
It completely changes the math. Market orders give you speed but cost you the spread or more. Limit orders give you price protection but cost you certainty of execution. In volatile markets or with widespread stocks, the risk of getting a terrible price with a market order is often much higher, making limit orders the safer bet for controlling cost.
So generally favor limit orders unless you absolutely need immediate execution and are willing to pay the spread cost.
That's the strong recommendation from the sources, yes, especially for retail investors.
Okay, what if you have to trade something that's just always illiquid, like a very small cap stock with a permanently wide spread? Any specific tactics there?
Yeah, the sources mentioned a few things. Obviously, patience and limit orders are paramount. Also, maybe using technical analysis trying to identify potential support levels to place your buy limit orders, or resistance for sell limit orders, where you think other traders might also step in.
Try to place limits where the action might be.
Kind of. Some traders might even try trading during less active hours, thinking fewer big players might be pushing things around. But again, spreads might be even wider then, so it's tricky.
A gamble.
A bit.
Yeah.
Another idea, though more complex, is looking for related, more liquid ways to get exposure. Like if there's an ETF that holds the illiquid stock, maybe trading the ETF is easier.
Right.
Or options, if they exist and are liquid enough.
Okay, exploring alternatives. And you also mentioned watching the bid and ask prices move.
Right. Don't just stare at the last price ticker. Watch the actual bid and ask, are they both ticking steadily higher? That's a stronger sign of buying pressure than just seeing the last price jump because one small trade hit a high ask.
See the direction of the whole spread?
Exactly. If both bid and ask are grinding lower, that's more convincing selling pressure. It gives you a more nuanced feel for the immediate trend.
This is super practical stuff. tying the concept directly to trading actions. Okay, let's circle back and hit those specific confusion points from the online discussion again, just to make sure we've nailed them.
Good idea. Reinforce the key takeaways.
That question, why isn't the spread zero? We covered it, but recap.
Recap. Spread exists as the payment for liquidity providers, market makers, taking on risk and providing the service of immediacy. Zero spread means a trade just occurred at one price. It's not the state of waiting unmatched orders where a gap naturally exists. No incentive without the spread.
Right. And the idea that market orders sometimes fill between the bid and ask, or the market maker profit, seems like magic.
Yeah, that touches on price improvement. Sometimes your broker or the execution venue finds liquidity inside the best nationally quoted bid and ask, the MBBO, so your market order might fill a fraction of a cent better than the displayed ask, or you might sell a fraction higher than the displayed bid.
Which is good for me, the trader.
It's great for you. Competition drives this. Also, sometimes odd lot trades, less than 100 shares, can happen inside the main spread and might not impact the NBBO quote directly. And the market maker profit isn't magic. It's that aggregate model capturing fractions over massive volume.
Okay. What about block trades? How do those huge institutional orders happen without blowing out the spread?
Right. Institutions trading huge chunks of stock usually don't just dump them onto the main lit order book. That would cause chaos.
Too much impact.
Way too much impact. And they'd get terrible prices.
Yeah.
Instead, they often negotiate these large trades privately, off exchange, maybe through broker networks or in dark pools.
Dark pools sounds mysterious.
They're just alternative trading venues not visible to the public until after the trade is done. They allow large blocks to trade between institutions without scaring the main market. The trade still gets reported publicly afterwards, but the execution happens away from the visible order book.
Okay, so a separate mechanism for the big players. And the last confusion point. Is the spread the only measure of liquidity?
No. And this is crucial. The spread is a great first indicator. Narrow suggests liquid. But you need to confirm it by looking at the market depth. True liquidity requires both a narrow spread and substantial volume sitting at the bid, the ask, and the price levels just beyond them.
Need the width and the volume.
Exactly. A 1-cent spread with only 100 shares on each side isn't truly liquid for a decent-sized order. A 2-cent spread with thousands of shares stacked up has much better, deeper liquidity. You need both pieces.
Spread plus depth equals true liquidity assessment. Got it.
That combination tells you how easily you can really trade size without causing big price moves.
Man, this has been incredibly thorough, from the basics right through to market structure and actual trading tactics. Let's try and boil it down. Key takeaways from this whole deep dive.
Okay, number one, the bid-ask spread is that gap. Highest buyer price bid versus lowest seller price.
And it's a real transaction cost. You pay it when you cross the spread, typically with market orders. Buy at ask, sell at bid.
It's dynamic. It reflects supply and demand in real time. And it changes based on liquidity, volatility, volume, time of day.
Market makers are key. They provide the liquidity, quote, the prices, and aim to profit from capturing that spread over many, many trades.
The order book is your window. It shows you the bids, the asks, the spread, and crucially, the market depth, the volume behind the prices.
And knowing all this helps you make better choices. Check the spread first. Gauge liquidity. And strongly consider using limit orders for price control, especially when spreads are wide or markets are choppy.
It fundamentally changes how you should look at a stock price. It's not one number. It's a negotiation range, constantly shifting.
All right, so here's a final thought to leave everyone with, building on all this. Think back on your trades. Every single one had a bid-ask spread cost embedded in it. Did you ever really factor that in?
Yeah. And how might consciously looking at the spread, assessing the liquidity before you trade, even for longer-term holds where you think timing doesn't matter as much, how might that change your approach, maybe even which stocks you choose to trade?
And flip it around. If the market makers are actively working to capture that spread profit, what are you losing or missing by not understanding those mechanics? Could watching the order book, the depth, the flow, could that reveal subtle signals about supply and demand that you're just not seeing right now?
It's definitely another layer of market awareness. Understanding the spread is understanding the real cost and the real game of trading.
Great stuff. Thanks for joining us on this deep dive into the bid-ask spread. Hopefully this gives everyone a much clearer and maybe more strategic view of this fundamental market concept.